As I was preparing for this talk, I started thinking about all the different things that are going on in the world and what we should talk about. And I thought, what could I tell you in 25 minutes that would really help you in investment thinking and processing information? And this is something that I developed many years ago when I first started. You listen to all different experts. You got experts, very qualified people on both sides of the fence. They all have well thought out programs, and yet they disagree. So how do you sort it all out? What I came to the conclusion is that there is so much information. While it's all interesting, it all affects things, there's only three things that are truly important to concentrate on. And if you concentrate on those things, you'll probably make very good investment decisions. You won't always be right, but you have at least the drivers that cause investment performance. And those things are inflation, interest rates, and the fundamentals of the companies. Now that sounds simple, but if you concentrate on those things, it'll guide you in the direct way. In the last few talks that I spoke in front of TEXPERS, I talked about many of the positive things that are going on in the country. Even though there are a lot of short-term negatives going on, there are some very positive things going on in the country that are kind of lost in the shuffle of what is going on in today's newspaper. So I'd like to take a few minutes to remind you of those things, and then we can talk about the three things that I'd hope to discuss. The first thing that I mentioned in one of my talks is the explosion in natural gas. This is truly a game changer in economics, and it is truly phenomenal to see it happen. We are, for the first time in this country, going to be able to create a surplus in natural gas which will allow us to export. Prior to this time, we were only importers. Now we are going to be exporters. We have the capacity to produce natural gas at $4 to $4.50 per thousand cubic feet. We can ship it for another $4 to $4.50, and we can sell it in markets as high as $16 in Japan and in Europe at $10 or $11. So this is going to be a tremendous opportunity for the United States. In addition to that, it is now estimated that we've got a 100-year supply. I just recently saw a study that was produced in Texas that said that the natural gas drilling won't even taper off for the next 20 or 30 years. So this is something you cannot lose sight of, because it leads us to the next thing that's very positive in this country, and that we are becoming the low-cost producer because of this natural gas. There are things going on in manufacturing that are pretty exciting, but one of the most exciting thing is that we're going to be the low-cost producer of natural gas. There are companies from all over the world planning to open up plants in the United States to be able to take care of this low cost in energy. Matter of fact, the ironies of ironies, would you ever believe that a Middle Eastern country, Egypt, is bringing over their largest fertilizer manufacturing plant to set up in America because they can buy the natural gas cheaper here than they can in the Middle East. So this is truly an amazing thing. The other thing that's happening in manufacturing is computer-assisted manufacturing is developing very rapidly. Just to give you an example, Nike used to ship their tennis shoes overseas. It would take 37 steps to produce a tennis shoes. They now have a computer-assisted machine that will literally weave the tennis shoe like a sock. They've eliminated 35 parts of the manufacturing process, and they are now able to produce these tennis shoes in the United States as cheap as they were anywhere in the world. They saved the shipping cost, and they've reduced the waste tremendously. So that's another area. And then the most exciting thing in manufacturing is the 3D printing. This is something that's just out of dreamland. They are now able to take a computer-designed blueprint. They put it into a machine which pours into liquid materials, and then they build it right into the machine to where they can literally produce parts just like you would print on a piece of paper. Matter of fact, in science and technology, They are already experimenting in taking human cells, printing a blueprint of a kidney, and actually being able to create a kidney. One of the major developments in the science area is in that field, and obviously that'll eliminate all problems with transplant because they're using your tissue and you don't have to worry about rejection. So these are some phenomenal things that are being developed, and it's going to create us, United States, as low-cost producer in manufacturing. Matter of fact, in order for Europe to be competitive with America, they have to reduce their costs 30%. You can see the rioting in Greece and Portugal and Spain and all of these countries because they have to lower their costs. And despite all the costs that they've lowered, they still got to go another 30 to 40% before they can even be competitive to the United States. Japan is no longer competitive with the United States. They're bringing their automobile plants over here, and they're starting to print money again to reduce the value of the yen because they are so uncompetitive in compared to the United States. China, which used to be the main competitor, is still a competitor, but because of the wages and the unrest and the shipping and so forth, there are many companies that are starting to bring their plants over. Because of these items I've mentioned, the long-term future of America is very bright indeed. What has changed? Well, one of the things that has changed is the market's gone up about 30 to 35% in the last couple of years, and we are now approaching a market that is in the 90 percentile of evaluation. So one of the first points I want to make a point to you, and I'm going to show you on the next chart. This is a chart I showed you last time. It's a very simple chart to understand. It'll help everybody get a real good idea of where we are in the market today. And by the way, this is my favorite chart. Basically what this is not a price chart, this is a price earnings chart. And what this shows you is that over the last 35 or 40 years, the market has fluctuated on this particular index from the bottom 10 times to the top 20 times. So it's very simple. In 2009, when the market was way down, it was at 10 times earnings. It's only hit 4 times, only 4 times it's hit 10 times. Now, let me explain why this is such a good index. First of all, it's not an average. It is a median price, so you get the distortions removed. Number 2, it is 1,700 companies instead of 500 on the S&P and only 30 on the Dow. It includes a lot of the mid and small cap companies, and so it gives you a much better idea of the broader the company. Now, in this environment, I would suggest to you that while the peaks are 20, in this environment, because we have such slow growth, your PE probably wouldn't get over the 17 to 18 area. We are at 16.1 today. So if 17 to 18 is your peak, you're probably only got 5 to 10% before it is a fully priced market. So the first thing I want to leave you with is this is a fairly valued market, and while it may have a few percentiles left, this is something I want to bring to your attention. The second thing I want to bring with your attention is what we were going to talk about is defects of inflation. Now, a lot of people are worried about inflation, and we do have the potential for high inflation, but we only have that potential. There's a lot that can be done to prevent it, and it's going to be years before it really becomes a problem, as I'm going to show you later. But just to show you on the next chart, I'm going to show you the effects of high inflation. Once you look at this chart, you see what happens. In 1974, the market was fully priced. The inflation rate was only 2.8%. And in a matter of 2 years, literally on a month-by-month basis, the inflation went, you can see it in your yellow boxes, from 2.7 to 12% in 2 years. And it drove the market down 45%, large cap 45%, the average stock 75%. It was one of the worst bear markets since the Depression. So that's what inflation can do. That's what everybody's worried about. And I understand why they're worried about it, but I'm going to show you why that doesn't necessarily have to end up this way. But I did want to show you the effect, and a lot of it's going to be dependent on how the Federal Reserve reacts to this. And I'm going to give you some guideposts to help you watch for that, because I went through that particular inflation. And right at the bottom there in 1974, I started Century Management on the premise that, number one, everybody was worried about the market falling apart, which I'd already done, and they were worried about long-term inflation. And I said, I'm either going to make a lot of money or it's going to be the end of the world. And so usually it isn't the end of the world. About the only thing that keeps ending is people. The world keeps going on. So anyway, let's take a look at the next chart and look at inflation and see what the potential is. This is a chart of how high the monetary base has moved up. And you can see that the Fed has been creating liquidity like we've never done in over 100 years. This is one of the highest levels of leverage on a balance sheet of the United States. So that is something truly to be concerned about. And like I say, this is not inflation, it is the potential for inflation. Now, why have we not had inflation? This money's been sitting there for 5 years and it hasn't caused any inflation. Why have we not had inflation? Well, I can show you that by the next chart, because the money hasn't gone into the economy. The money has gone into the banks. So if the money would have gone into the economy, you would have had huge inflation like we had in the 70s. But the money has gone into banks. Now, why is it sitting in the banks? Because the banks are parking it with the Federal Reserve. They get an interest-free loan. They're making money on their reserves. And they're very happy to sit there. They take no risk. And they're getting paid to sit that money there. It's not costing them anything. Now, until that money goes into the banking system and through to the economy, you're not going to have inflation. So I just want to point out one thing. Creation of a lot of reserves doesn't necessarily have to lead to inflation, and I'm going to give you a precedent for that. Let's look at the next chart. This is the experience of Japan in 1989, 1990, when they had a huge speculative bubble both in real estate and the stock market, and the Japanese created reserves like we've never seen anywhere in the world. This is 2.5 times what we have printed. So they printed 8 times. We have only done 3.2 times. They kept it in there, and then they drew it out. So that's the first key you want to think about. If in studying inflation, you have to ask yourself, are they going to pull the money out? If they pull the money out, you can go a long time without inflation. If they leave it in, we're going to have inflation of the 70s. But that's an easy thing to do. You just watch what the Federal Reserve is doing. Now, during this time, Japan created this tremendous money supply. The inflation never got above 2%. Now, that is truly significant to be able to create that much inflation or that much reserves and not have any inflation. Matter of fact, for the 10 years that they created that, their inflation was actually zero, was just a little minus. So the point I'm trying to make is all of this talk about inflation isn't going to happen unless the Federal Reserve keeps that money in there. And I'm going to show you that they got plenty of time to move it out if that's what they want to do. And by the way, it is the Fed's intention, as Bernanke has said many times, they're going to bring this money out to bring the economy together, and then they're going to pull it out just like the Japanese did. And if they do that, you're not going to have the kind of inflation. Now let's take a look at our inflation. We have been running around 2.4% in inflation if you look at the CPI. Now, for many years, I thought the CPI is kind of a fraud because it always seems to understate inflation. But I've done some recent studies lately, especially because this inflation is so concerned, and I actually found out that the CPI is fairly accurate over the long run, but many times it lags. And so you have a distortion for 4 or 5 years, but eventually over the long run it catch up. So I do have a little more faith after that study into the CPI. However, it is lagging now. I would say that the real inflation is probably running around 3.5%. There's an organization called the American Institute for Economic Research, a nonprofit organization. You go to their website, They have an EPI, Everyday Pricing Index. They've created their own independent index to see what the average person's cost of living has gone up, and it's running about 3.5%. So the CPI is lagging a little bit, and the reason it's lagging is that 40% of the CPI is the owner equivalent rent index, which means as rents go up, that will be reflected in the inflation numbers. So I would expect in the short term the inflation to kick up a little bit, but I'm going to show you why I do not expect inflation for many years and how you can monitor it, and this is one of the things I want to leave you with. One of the things that I've learned is over the last 10 years, commodities have moved up about 7%. So we've had inflation in commodities, oil, gold, you name it, it's gone up. Well, why hasn't it registered in the CPI if we've had commodities going up 7%, but the inflation is only showing 2.4? The reason is that the biggest cost of inflation is human labor. In any products, it costs between 60 to 80%. And there's the rub, as you probably note in your salaries, most salaries haven't gone up for the last 5 years. So you're not going to get wage inflation until salaries go up. And the studies show that people aren't even, from a real rate of return, from an inflation-adjusted point, the salaries aren't even back to 207. So for 5 years, salaries have been stagnant. Now, if the average median income in the United States is $50,000 and somebody has to pay more for gas, and they don't have any more money coming in, they spend more for gas and they spend less on food or on clothing or other things. So the commodity prices will eventually average itself out as people spend more on energy and less on other things. Matter of fact, the commodity index hit a high of 700 on the index last year, and it's been coming down just as gold has been coming down because the effects have already started to percolate through. So first of all, you're not going to have as much commodity inflation going forward. It's already discounting this. And the second thing is you're not going to have much in wage inflation, and I'm going to show you why. Over the last 6 months and over the last year, we've averaged 180,000 new jobs a month. But there's 110,000 new people coming into the economy who are looking for jobs. So if you take 180,000, you take 110 that are coming in, that leaves you with 70,000 people that are really getting net jobs. After we take the people coming in, we only end up with 70,000. Now, in order to get tight labor markets to where people can negotiate and get raises, we're going to need to get the unemployment down to about 6.5%, and that's going to have to take 4 million jobs. Now, if you take 4 million jobs before you get a tight labor market, before you get wage inflation, and you're only producing 70,000 a month, it's going to take you 4 years and 9 months before you get a tight labor market. During that time, it is Bernanke's desire that during that time, he's got plenty of time to move this money out. Now, whether he does it or not, I don't know. But from what I can see by reading the Fed minutes, you can see that there are a lot of people on the Federal Reserve Board that are very concerned that we're going to pull this money out. I do not believe that it is possible for them to keep that money in once inflation starts showing. Lyndon Johnson had control of Arthur Burns, the Federal Reserve Chairman at that time, and he pretty much controlled him and allowed him to keep that money in. But I don't think that it is politically feasible for the Federal Reserve to pull a repeat of 1970, especially when so many people who lived through that area are still out there voicing their opinion. However, if they do leave it in, then those people who are predicting high inflation will be right. If they pull it out, which I've showed you, we've got plenty of time, you're not going to have any problems. So that's the inflation thing. You watch what the Federal Reserve's going to do. If they start to remove those reserves out, you can quit worrying about inflation until you have a tight labor market. Now let's talk about interest rates and bond prices. First of all, there's two things that cause interest rates to go up. Number one is credit risk, and number two is inflation. We've just discussed the inflationary situation, so let's talk about the credit risk. When you look at Spain, Greece, Italy, and Portugal, these countries had very modest inflation a couple of years ago. It was running around 2.5%, 3%, a little higher in Spain at 4% in Italy, but pretty much like the US. And all of a sudden, Spain's bond went from 4.5% to 7% in a matter of weeks, and over a year and a half, it just spiked up. Greece went from 4.5% to 5% to 30%. Italy went from 4% to 7%, and Portugal went from 5% to 20%. What caused this tremendous increase in interest rates if there was no inflation to speak of? The reason was that these countries were so heavily in debt, and the debt was piling up because of the recession, that people started worrying about getting their money back. So credit risk is one thing that will drive up interest rates, and I'm going to give you the guidelines. In Spain, debt to GDP was 90%. In Greece, which is the basket case, it's 170% to GDP. In Italy, it's 127%. And in Portugal, it's 118%. The general thinking among people in the international monetary thinking is that when a nation gets to be about 115 to 120% in debt, that's when people start worrying about getting their money back. We are today at 103%. We are not at the zone that any of these other countries were in. But I want to point out to you that that is a risk when it comes to interest rates. It has nothing to do with inflation. It is because people would be worried about the credibility of the United States government to be able to pay down that debt. I think it would take at least 5 to 7 years, even at the ridiculous rates that we're going now, before we would get into a position where people would start worrying about getting their money back. That is not a very long time, so we need to be thinking about it now, but I'm giving you the gauge. The gauge is that if the debt to GDP starts to go over 110, 115, and into 120% range, then you start have to think about the interest rate risk due to credit risk as opposed to the interest rate risk due to inflation. I don't see those in the immediate forehand, so I do not believe that interest rates are going to go up dramatically, nor do I believe inflation is going to go up dramatically. In the 70s, we had a very low debt to GDP ratio. That's why the Fed was allowed to be able to continue on. Today, there is so much debt in the economy that it will weigh on a nation if the interest rates start to go up. Let's take a look at the next subject, and that is household liabilities. The good news is that the debt service of the average person has gone down about 29%. You can see that on the average budget, the average American was spending 19% of their budget on paying debts, credit cards, cars, and so forth. On the bottom ratio, which includes mortgages, we went from 14% to about 10%. So the budget cost of debt service for cars, credit cards, and homes has gone down about 25%, and that is what's helped this economy. That is Bernanke designed to get the interest rates down, to get people to pay less for their debt service, have them purchase more, and get the economy going. There's only one problem with that. While the debt service has gone down 25%, the debt has only gone down 7%. It went down from 14 trillion to about 13 trillion. So you can see that we still have a mountain worth of debt that we have to work off, and that is going to put pressure on the economy, create a slow growth environment where interest rates and inflation will be very subdued. Now let's take a look at the next slide, and I'll show you the total debt for the United States, which includes private and public. That's everybody. And you can see how this has gone up. And while the debt service in the United States government has gone down tremendously, 25% or so, the debt really has only gone down about 7%. And here's the danger in high interest rate. The government, unfortunately, has most of their debt, 49% of their debt is going to come due in 3 years. And they've got it all short. They should be out there buying the long bonds instead of having it short. So if interest rates go up, If interest rates were to go up from 2 to 4%, the deficit would go up another $300 or $400 billion in debt service. So that is a concern that we have to be worried about. In conclusion, I would like to state that there's 4 things that I've left you with today. 1, you should consider your equity exposure because the market is getting into a zone. The inflation risk is out there only if the Federal Reserve keeps the money in there. If they pull it out, we have a very good chance of getting by with 3 to 4% inflation maximum. If they don't withdraw the reserves, then we have the 70s style thing. The most important thing to watch is wage inflation, because that will tell you whether we're going to have inflation. You're going to have plenty of time to watch for that, because it's going to take 250 to 300,000 jobs per month before we start cutting into the time zone. The earliest I could see that happening is 3 years, and more likely it's going to be 4 years. So in the conclusion, I'd like to state, concentrate on inflation, concentrate on studying the interest rates, concentrate on the business fundamental. The rest is all moonshine. Thank you very much.